I think that for many instances, you're better off not working with a broker, working with a fee-only planner. And this will help you in a few ways. It will definitely lower the cost that you're paying inside of your 529 plan because there isn't a cost built in there to compensate your broker. And it also opens up all 529 plans potentially to you to really choose from the best plan.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This week we're going to switch things up a little bit and we're going to talk about helping your grandchild pay for college. Believe it or not, there are a number of ways that you could help your grandchild pay for college, and I have come up with 9 ways that you could help your grandchild pay for college. So I'd like to go through those different options, talk about the pros and the cons, and give you some tips as far as what I think are some of the best ways. So way 1 is that you could pay tuition directly. You may not be aware, but you're actually allowed to pay college tuition for a grandchild directly, and this is not subject to any gift taxes. It's a really simple way for you to help pay for your grandchild's college. Normally, if you're trying to give someone a gift, you're limited to $15,000 per year. That's the current gift allowance. If you go over that amount, there's still a lot of room that you have to then use up what's known as your lifetime gift allowance, which is over $5 million. So for most people, it's not really going to matter. But if you don't want to worry about filling out a gift tax return, this is one way that you could do that. Some of the cons of paying for college tuition directly are that it could negatively affect the student's financial aid eligibility. So just be aware that this tuition payment will be counted on their FAFSA and could reduce their ability to get financial aid in the future. And the gift tax exclusion only applies to tuition. If you do want to pay for their books or other supplies, room and board, that will be subject to the gift tax limit. Way number 2 would be to offer your grandchild a loan. This is a way that you could pay for the college. They could have some responsibility as far as knowing that they have to pay you back. The IRS allows you to give them up to $10,000 interest-free loan. Anything above that, you have to charge them an interest rate, and it could be a good way for them to be responsible for their college. The cons, however, are that interest that you're getting back on the loan is taxable income to you that you need to report on your income tax. It's not deductible for your grandchild. And if you end up forgiving the loan, you may end up owing income tax on the debt forgiveness. And, could also make things awkward over Christmas or holidays if your grandchild doesn't pay you back. Way number 3 is that you could pay off your grandchild's student loans after they graduate. This is positive for a number of reasons. One being that there's no negative effect on their financial aid, so they could borrow whatever is appropriate and without any limitations. Then when they graduate, you could pay that off. You could either do it in a lump sum, you could just make the payments for them, and they have an incentive to graduate knowing that you're going to pay this off for them. If you're paying this off over time, they can also still deduct student loan interest up to $2,500 on their tax return. Some of the cons are that these loan payments will be considered gifts. So any amount that you're paying over $15,000 will have to be reported as a gift tax. However, if you're married, each individual can gift $15,000. So a married couple could pay for $30,000 a year without having to worry about any gift taxes. And however, college costs are expensive. It may be more than the gift tax allowance. And also, if you're planning to do this, you'd want to make sure you have something in your will that lays out that you'd still fulfill this obligation if, unfortunately, there's an untimely death or illness. Way number 4 would be to buy your grandchild U.S. savings bonds. This is definitely an older tactic. U.S. savings bonds are easy to buy. You can buy them at a local bank or at treasurydirect.gov. They're relatively safe. However, you're limited to buying $10,000 per year of Series E or Series I bonds, and the interest rates are pretty low on these bonds, so you're not getting a great return on your money. Way number 5 is that you could set up an education trust. So you could set up an irrevocable trust where you put a certain amount of money into the trust, and the trust would then lay out how your grandchild could get access to this money as far as whether it's available upon graduation, or they're able to get out a certain amount per year. So you could be very specific about that. Some of the cons are that there's costs to set this up, establishing a trust. There are legal fees involved. You may need to hire a trustee if you can't find someone to be the trustee, because you can't be your own trustee because it's an irrevocable trust. And as I mentioned, it is irrevocable. So if you change your mind, unfortunately, there's no going back on this. Also, whoever's managing the trust just needs to be aware that certain investments inside of the trust could generate income, which could be taxed at higher rates. So you want to be aware of that. Way number 6 would be to set up or contribute to a custodial account. These are known as a Uniform Gift to Minor account, a UGMA, or a Unified Transfer to Minor account, UTMA. The pros of these is that you can easily transfer cash, stocks, or other property into these types of accounts. You also can pay less tax on any dividends, interest, or capital gains in this account because the child is allowed to pay a certain amount of tax on the income up to a certain level, and then the kiddie tax kicks in, which then would have the remaining taxes be paid at the parents' tax level. Also, there's no limit to how much money can be put into these accounts. You're just subject to any gift tax restrictions. So you could put a significant amount of money into one of these accounts because it isn't possible for a child to own stocks or individual investments. Some of the negatives, however, are that once the child reaches the legal age of majority in that state, in my home state of Connecticut, that's 21, the property in that account is legally owned by that child. Institutions that hold these accounts are required when the child reaches the age of majority to reach out to that child, let them know that this property is now theirs, and turn the account over to them, essentially cutting the parent or whoever is the custodian out of the equation. So if you don't want that to happen, then don't put money into these accounts, because I have seen situations where the parent didn't let the child know this account was theirs. The financial institution then contacted them, and then the child took the money and did what they wanted, and that wasn't really what the parent wanted. Additionally, because at the age of majority, this asset goes into the child's name, this could really negatively impact a FAFSA because assets held by a child weigh a lot more heavily than assets held by a parent. So way number 6 would be to contribute to what's known as a Coverdale Education Savings Account. These accounts allow you to put up to $2,000 a year away. That could be used to pay for college expenses as well as certain K through 12 expenses. So the pros of the accounts are that you get tax deferred growth and it could be invested, however you want. And the negatives, however, that you're only allowed to put $2,000 a year into the account, and that's really not going to cover a lot of expenses. Way number 8 would be to open a 529 plan in your name and designate your grandchild as the beneficiary of the account. And the benefits of doing this, the pros, are that you still have control of the account. So let's just say you set up a 529 plan for your grandchild and they decide not to go to college. Well, because you still own the money, you can take the money back. You could pull it out and pay tax on it, or you could actually designate another grandchild to be the beneficiary of the account. Depending on the state, each plan is offered by a different state, dictates how long the money could stay in there. Some states allow the money to stay in the plan until your grandchild reaches the age of 30, before you'd actually have to do anything with the plan. Additionally, you could put 5 years of gifting limit into the 529 plan in one shot, which means that you could put $75,000 into a 529 plan when you first open it without triggering any gift taxes. And that's per individual. So a married couple could gift $150,000 into a 529 plan. Now you could gift above that or put above that into the 529 plan, but you would be going past your annual gift allowance, and then you'd have to just keep track of how much of your lifetime gifting limit you're using up. Now, most 529 plans have a maximum account balance per beneficiary, And once the account hits that level, no further contributions are allowed. For example, one of the 529 plans offered in Connecticut, the CHEP plan, that amount is $300,000. So once the account hits that, it can stay open, but no future contributions are allowed. Another positive is that your grandchild could use the funds from the 529 plan to pay for any eligible post-secondary institution. And depending on what state you live in, there may also be a tax deduction that you can receive by making this contribution. There are, I believe, 34 states that are currently offering tax deductions, and some states also offer tax credits. So in my home state of Connecticut, you can take a tax deduction up to $10,000 per couple per year against your state income tax. Now, some states don't have income tax, so there's no tax credit. Some of the cons of these accounts is that this money is not going to have any impact on your grandchild's financial aid because it's in your name. However, when you start withdrawing money to pay for his or her college, this will be counted as income for them on their FAFSA. And if you change your mind, as I said before, and you want to take the money out, any withdrawals that you take that are not qualified withdrawals are going to be subject to income tax and a 10% penalty, but that's only on your gains. Another negative is that in some states, money that you have saved in 529 plans would be considered available assets that must be spent prior to being eligible for Medicaid. So you'd want to be aware of that before you put money into one of these plans later in life, and then having you need to go on Medicaid and having this count against you. Way number 9 to help pay for college for your grandchild would be that you contribute to a 529 plan that's already set up for your grandchild, presumably owned by your child or their parent. And the same benefits that we talked about before, the tax deferred growth. Another benefit is that when money is withdrawn, it will not count as income on the student's FAFSA. However, a con is that when the parent fills out the FAFSA form, this asset will be counted towards their eligibility. And you're also giving up control of these funds because now you've given it as a gift and it's in the parent's control. And you may or may not be able to claim the state tax deduction or credit. You'd have to check with your local state and also your accountant. Now, I do want to talk a little bit more about 529 plans because 529 plans vary from state to state. And the way that these have been set up, for good or bad, is that every state has their own 529 plan or multiple 529 plans. And the state has decided to contract with a company, an investment company, to build the 529 plan, to choose the funds. And so you really have to be an educated consumer about setting these up. Now, there's a great website where you can go to find out information about states' 529 plans, and it's called savingforcollege.com. So if you go to that website and you want to find out whether or not your state offers a tax deduction for contributing to a 529 plan, that's a good starting point. And then you can also look to see what the plans in your state look like. And there's generally 2 types of plans. There's plans that are direct plans that are not sold by a broker, and there are also plans that are sold by a broker. Now, you probably know from some of the previous podcasts that I've done, especially the last one on annuities, I think that for many instances, you're better off not working with a broker, working with a fee-only planner. And this will help you in a few ways. It will definitely lower the cost that you're paying inside of your 529 plan because there isn't a cost built in there to compensate your broker. And it also opens up all 529 plans potentially to you to really choose from the best plan. So how do you decide whether or not a plan is a good one? Well, really, it comes down to the costs in the plan. And I would say that some of the better plans out there, the CHEP plan in Connecticut is a good plan because it has some very low-cost investment options. Vanguard has a plan in the state of Nevada that's another good plan because it has very low-cost investment options. So that's definitely one thing you want to look at. Another thing that you want to look at is to see, can you choose the investments or are you forced into an age-based asset allocation? Age-based asset allocation would mean that when the child is younger, the account is more aggressive, and then the older they get, the more conservative it becomes. And this is definitely a good option. But if you want to have more control over how the money's invested and you want to be able to move it to be more conservative or more aggressive, then you're going to want to find a plan that has the ability for you to select your own investments. Now, be aware also that by federal law, you're only allowed to change your investments inside your 529 plan twice per calendar year. Seems pretty archaic that that's what the rule is, but that's what it is. So when you're picking your investments, make sure that you're comfortable being in them for at least 6 to 12 months before you can make a change. And if you happen to be in a state that does offer a tax deduction, but it's not a good plan because the investment choices are limited or the costs are high, keep in mind that you can contribute into that state plan, get the tax deduction, and then you can transfer the money out to another plan that maybe is better as far as lower costs, better investment options. And you can keep doing that and making those transfers over time. With these 529 plans, you're not limited to having your child only go to a state school to get those benefits as far as withdrawals in a tax-free manner to pay for college, but it also can be used to pay for a vocational or trade school as well. A recent change in the last few years also allows you to take up to $10,000 a year and pay for K through 12 expenses. You also could change the beneficiary to yourself if you end up deciding to go back to college, and you can use it to pay for your own college or college-related costs as well. Some states also might match what you put into the account. I know in Connecticut, they have something called the Baby Scholar Plan, where if you open a 529 plan and contribute before your grandchild reaches their first birthday, then you're able to get a $250 bonus. As long as you put $150 in, you get a maximum of $250. Now, to qualify for that, they have to be a resident of Connecticut, your grandchild that is, and you have to make the contribution before they turn 1. But that is a way that's free $250 out there if your grandchild happens to live in Connecticut. So make sure that you do that. I was lucky enough to know about this and do this for my own son. So I hope you found this beneficial on the different ways that you can help your grandchild pay for college. As a reminder, my retirement readiness workshops are going on right now. There's still a few classes that haven't started, so you could sign up by going to retirewithryan.com or by going to morseawealthmanagement.com. Have a great week. Talk to you next Wednesday.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.